What happens if we don't manage our risks? Just imagine the first trade you took was a losing trade and the price dropped 50%. It will require a 100% return to get back to your original balance to break even. It will be challenging to do and will take a long time to achieve. The next 5 trades could be winners, but they only generate 5% return each. You see, a 25% return is not bad at all, but the loss you made in your first trade was too big due to lack of risk management. If you have a proper stop loss in place, you might have cut the losing trade short when it dropped 5% and entered into other profitable trades. That's why risk management is so important, because it avoids traders being wiped out by a few unfavorable trades, protecting account from losing streak, minimize opportunity costs, and preserve our funds for the next trade. Winning trades and losing trades come in random sequence. A strategy with an edge is expected to have bigger wins and smaller losses, or more wins and fewer losses. But the expectancy can only be realized after a significant number of trades. Also known as the law of large number. So how many trades do we need to be considered as a significant number? The answer is the more trades you take, the more likely the results will return to its true edge. And while we are trading to exploit the true edge of our strategy, in the many trades we do there must be streaks. Although we welcome winning streaks, losing streaks are equally likely to occur. Quite often the losing streak can cause traders to lose faith in their strategy and tempted to throw away their strategy to look for a better one before they can monetize their true edge. That's why it is important to do your due diligence on your strategy thoroughly before trading live, so that you can be confident that it has an edge and its edge is most likely to preserve in the future. So you can trust it and trade it through the ups and downs to monetize your strategy. To survive the drawdown period, risk management is crucial. On one hand, you don't want to risk too much that when there is a losing streak you will easily blow up your account. On the other hand, you don't want to risk too little that each trade becomes meaningless and can't really help you to achieve your goals. As a rule of thumb, once you got familiarized with your strategy, risking 1 to 2% of your account size per trade is considered as ideal. It provides a balance between protection from losing streaks and sizable profits on your account when winning. You can see from the maximum drawdown table, for each percentage you lose from your account you'll need a greater return to compensate the loss for returning to the original balance. Therefore, good traders are also a great risk manager. Because they know protecting the trading capital is more valuable than solely focusing on the highest returns. Our goal is to research for strategies that can generate highest returns with minimum drawdown. Let's open the position sizing calculator Excel file in the attachment. First, we need to set the percentage of our account we want to risk per trade. By default, we set it to 1%. Next, we need to enter our account value. The Excel will calculate the percentage of your account value. And to make it like real trading, we also need to include the spread and slippage for our trades. By default it is set to 2% of the risks. Then we need to measure the distance between our entry price and the stop loss. The calculator will automatically calculate the actual risk per trade by adding the spread onto the distance between entry and stop loss. It will calculate the number of units you should buy for long, sell for short, on the asset that you are trading based on your risk management rule. To explain what the position sizing calculator is doing, it simply takes the percent you want to risk from your trading account and divide it by the distance between your entry and stop loss plus projected slippage on price. If the price hit your stop loss, you will lose exactly the percent of your trading account that you've specified. This is an essential tool for managing your risks in trading. You should use it to size your position properly before entering trades. It's surprising how few trading coaches out there discuss the maximum number of trades a trader should open at a time. This is a common scenario when you have multiple trading signals on different assets all happening at the same time. We must set a rule for ourselves so that we do not overtrade and take on risks that are beyond our tolerance level and over-concentrate our risks in a specific period. Traders sometimes made the mistake of oversizing their position without knowing. For example, they go long on EUR, USD and GBP, USD, because both currency pairs consist of USD. Opening positions on both will result in oversizing their USD position and doubling the risk. Another example is when a trader long on Coca-Cola and Pepsi. Since both stocks are highly correlated and operate in the same industry, it is highly likely that they are going to be influenced by the same factors. Opening positions on both companies will oversize your risks. And even when you are trading assets that are not highly correlated, you still need to limit the number of positions because there are external factors that will affect all the assets, also known as systematic risk. Therefore, I suggest limiting your open positions to 3. 3 is a good number as it can keep the trader occupied without being overwhelmed. And if you keep your risk level within range, your maximum losses are only 3 to 6%, which can be easily recovered by the next winning trade. And if the trades turn out to be winners, 3 open positions are also sufficient to bring in lucrative returns. Hence, providing a good balance between capital preservation and growth.